comes down to computers communicating.
The information superhighway can be a confusing mix of on-ramps and off-ramps.
Bitcoin is worthless artificial gold.
Is it still rat poison?
Probably rat poison squared.
We need to get into the world of, okay, this is actually foundational technology.
What the Internet of Money does is it creates a single network which can do a microtransaction to a gigatransaction.
The Internet is going to be one of the major forces for reducing the role of government. The one thing that's missing, but that will soon be developed, is a reliable e-cash.
Hey guys, welcome back to another episode of Final Settlement. This was an exciting and action-packed episode. No shortage of M&A deals and new products and releases in the ecosystem. Quick word from Onramp, an Onramp business specifically. I'm not sure we've had a chance to share it here. We launched this a few weeks ago. Incredibly excited about the product. We announced a case study with a large firm, but also really foundational infrastructure needed for businesses across the landscape that are adopting Bitcoin as a treasury reserve asset. Not only is multi-institution a superior way to custody the underlying than trusting a single custodian, but then naturally what's existed or what hasn't existed in the digital asset Bitcoin world is governance, access-based controls, and everything that generally exists in the traditional financial system has not been ported over when it comes to just treasury management of the underlying Bitcoin. And so with Onramp Business, institutions, enterprises get access to multiple users. They get access to creating quorum of quorums so they can decide on who has access to check off or approve a transaction before the withdrawal takes place. And then you get complete audit controls as well as multiple wallets, different quorums, everything that a large-scale institution would need. Really excited about this announcement. We're starting to onboard publicly traded companies as well as other large institutions. If you want to learn more, I'd encourage you to book a consultation or reach out. All right, on to the episode. I hope you guys enjoy.
All righty, boys. We are back. The banks are here. It's another episode of Final Settlement. Today is Monday, October 27th, 10:15 a.m. Eastern Time. Joined as always by Liam Nelson, Michael Tanguma. Boys, how are we doing? Big list today. Huge list.
We're doing good with the energy you're bringing, because we've heard feedback from, listeners and peers in this space, and, Jackson, they love him, but he comes in a little slow and warms up, and, it gets the juices flowing when you kick us off like that.
You got to bring the juices. It's Monday morning. The banks are here. They want your corn. They also want stable coins.
For your guys' time in the space, when are your most enjoyed pumps? I have two that come to mind. This ties into this. Is Sunday nights are always great going into Monday, but I really think the favorite from the past 8-10 years is Friday.
Yeah, we got the opposite a few weeks ago, but yeah, the Friday evening right into market close, I think, are the best pumps.
It doesn't even matter what day of the week. It's just like when you wake up at 3 a.m. and need to pee or something, and then accidentally check your phone and it's up $3,000 more than when you went to bed. Those are just the best feelings.
No, but there's a day. Everyone has the day. There's a certain vibe, because the one that I'll describe is Friday after work. I remember specifically being in New York City, and happy hour is happening, and the price is just ripping, and nobody has any idea what's going on. You're just sitting there by yourself, and you may have had a couple cocktails, and the price is just running. And this would happen every so often in 2018, 19, I think. And it's just Friday afternoon, because you're going into the weekend. You just, you're becoming wealthier. I don't know. That's
it's the meme of the guy in the party at the corner. No one knows that Bitcoin's price is ripping,
and it's just moving on your phone. It's just this thing it's a thing. It's a thing. But Liam 3 a.m. rips, 3 a.m. pisses, ripping pisses at any day of the night. He's agnostic to when the price pumps.
Always a good time for a price pump.
That is true. As I said, big list. We're going to get into it. We're going to start with JPMorgan. I said the banks are coming. They are here, and they're going to let clients pledge BTC and Ethereum as loan collateral by year end. It's almost year end. We're at end of October here. So this is the next 2 months. They're going to let Bitcoin be collateral. And this is pretty big news for a number of reasons, a few different ways we can unpack this. The first one to me is just, if you think about what is deemed collateral and asset classes moving into, reserve status or being used as collateral, you have different sort of epochs of things being used as collateral. You could look at, pre-1971 as gold, predominantly being used as a form of collateral, neutral, reserve, et cetera. And then, post 1971, you really move towards U.S. Treasuries as the default form of collateral. And you could also say in that time period that real estate was a predominant form of capital or collateral. And now we're adding basically a new asset to the mix of acceptable collateral, which is a pretty big deal, just again, in the sort of timeline of asset progression, asset development, and use as collateral. And so we're at, very early stages, as early as you could possibly be in terms of this new asset class being deemed worthy of being collateral. So what are you guys' thoughts on this?
Yeah, I mean, this one is huge. It's even you just sharing the collateral notion makes me think it's so much bigger. I won't go in any direct order, but having talked with banks, regional banks, they see stable coins as a big disruptor and they want to get in the game. And I think it's a little bit of a misnomer, misguided view. I think that they have to at best be in parallel looked at as priorities, because on the traditional banking, like two-dimensional take is they're going to see capital flight. It's better money movement, cross-border, all the things. And I know that's true, but the reality is most banking institutions do not, like from a retail, even business perspective, they still have to get trained up on how to use stable coins. So that's still years away versus if they're looking for Bitcoin exposure, we've seen what the ETFs have done. You should turn on the ability not only to trade, but also actively custody, get closest to that underlying, which is that collateral we're talking about. And now you can start to offer, whether it's Bitcoin-backed loans, which, obviously banks are in the game of lending money, cross-collateralization. So I think this is big because it shows another layer of not risk, but potential disruption that the big banks have already been disrupting and disintermediating the regional banks. So there's that. I think huge from just Jamie Dimon being one of the largest, and JPMorgan in financial institutions of the world to basically dismiss, call it tulip bulbs and ultimately come back and get involved. And then there's also the example of, I think that they're going to let you do both when it comes to pledging your ETF shares as well as the underlying, which is really fascinating because I think if there was just ETF shares, I'd be a little bit less interested or think it's so, groundbreaking. But the fact that they're going to get in the game of the underlying and figure out the underlying custody, have to figure out, the rest of that. And it shows also that they're like competing with deposits. They're competing with the underlying custody. They get that they want to be right next to it and offer financial services. The last part I'll say, though, is all of it is great. It also kind of is, I don't want to say it doesn't matter, but you got to be very wary because for 15 years, people have tried to lend against Bitcoin and they've pretty much blown up. Now, obviously, JPMorgan Chase is different, but I just think that it's worth sharing that when anybody drops a new product in this space, you really want to take a step back and just see what happens, how it works, especially with something that has historically not worked well for the lender, because this stuff is truly alien technology. I forgot who I was talking to about it last. It was actually a large bank and one of the largest banks in the country. And I was referencing because they were interested in MIC. It was explaining like this is alien technology in the sense that it trades 24/7. If you look at all the volatile periods, they happen at these nights and weekends. Thanksgiving night, when we used to run our lending desk at Unchained, those were always the most volatile. It was a running joke on Thanksgiving. You were just stuck near the computer. And then you have this asset that can go from 20 to 30, 40% drawdowns that you're not used to on a 24/7 market. And then you have, if you're caught short or naked, there's no bailouts. It's just a different ball game. And so TBD how it plays out for JPMorgan Chase.
Yeah, I think that there's a ton here. One, everybody's going to come kicking and screaming just because the market forces will demand it. We've seen how profitable the ETFs have been, and the clients just demand it. They want to be able to trade Bitcoin and Bitcoin ETFs. they've definitely done this, not because Jamie Dimon is, spearheading this internally and super excited about it. And he just, one sees that the clients are going to go somewhere else if they can't do it themselves. A lot of these hedge funds will trade on margin. And so they want to lever up their actual amounts of trade. And so that's not to say they're going to, put, out of all their portfolio, 500% long Bitcoin. It's going to be like a relatively small percent of their portfolio, and they'll trade against, future expectations of where the market's headed, and yada, yada, yada. But as you've seen, everything from the popularity of the ETFs, the amount of, clients that have got exposure to Bitcoin for the first time through the ETFs, and a lot of them probably are starting to get smarter on it, is it's become a larger percentage of their portfolio, and they dipped their toes in, what was it, January of last year now, and they've gotten more comfortable with the asset, and they want the underlying themselves. It's just the perfect example of every detractor that doesn't want Bitcoin. They think it's a scam until they can actually make money from it, and they're going to be educated from their clients, or their clients are just going to leave. But because JPMorgan's so big and they can have such a big balance sheet to lend against, people are going to want to work with them. It's just a massive just move for the industry. But the last thing that I will say, I am impressed with how quickly they're getting to market. I doubt that they're going to use a custodian themselves. I would imagine it's probably a sub-custodian, but they can offer a very big lending book that they can lend against. So it'll be interesting to see how much adoption this gets early on. I don't think it will be it'll be massive in Bitcoin terms, but it will probably be relatively small as people want to check out how this actually works, to your point, Michael, as well.
Yeah, agree with all of that. I think very good points around just the narrative, the bending of the knee. You watch the ETFs have such great success. You see BlackRock, it's their most profit generating product at this point in time. And you can't just ignore that. And we've also discussed the past few weeks around this idea that, whether it's OG whales or just people moving into these ETF products due to security concerns or the ability to get margin against IBIT shares, this is a natural competitive sort of move or pivot for the JPMorgans of the world to say, well, to your point exactly, Michael, let's just get closer to the underlying and do very similar financial services around the asset, but in a way that is not in a wrapper vehicle. Now, the interesting question is, how are they going to actually go about building out custody themselves or acquiring it using a sub-custodian like you referenced? And maybe that's a nice transition to another headline from the past week, which relates to, effectively single custodians and this notion of the big boys are here, the banks are stepping in. We've seen things like this in the past in terms of certain entities or trust companies being deemed quote unquote qualified custodians, being trusted to custody digital assets. But ultimately, being a single custodian brings a lot of risks in terms of having single points of failure and the ability for things to go wrong without fault tolerance and without fallbacks in place. And so I think this relates pretty closely to this news from Nevada shutting down Fortress Trust over insolvency. Now, if you recall, a few years ago, I believe this is, some of the same management team, if not the same management team from Prime Trust that went insolvent a few years back, lost $80 million in client funds. Michael, maybe I'll kick this one to you. Thoughts on this announcement or this development, because this has sort of been happening in slow motion over the past couple of years.
Yeah, this unfortunately has. I was kind of surprised that they were still around. I guess they had still been in some way operating. This whole situation stinks. If anybody's been close to the industry, you can search on Twitter and probably back into not only what happened with Fortress. I didn't know it was as big as 80 million in the losses, and then ultimately some of the executive team that went over to at Prime and then went over to Fortress. The real nasty part about the Prime and Fortress is there's a bunch of companies that back in the day when when the assets were lost, understood that, knew before the market did. They actually took assets off of them because Prime Trust used to be a custodian for a large percentage of the Bitcoin only firms. And then ultimately now there's lawsuits out there around clawbacks because it's been understood you can just track the movement, whether it's the blockchain or the ledgers that they use on capital leaving from their subcustodial relationships with Prime Trust and Fortress Trust. And now there's a bunch of clients holding the bag. Included on top of that is when you look at your IRA custodian, and then naturally there's been a stain when it comes to subcustodial arrangements in the IRA space because certain assets were stuck there. All is to say, this really ties into kind of also what I think, Brian, what you're relating to on the JPMorgan Chase side is kind of feel like sometimes we're taking crazy pills, but we explain that there's a reason on a long enough time horizon, the market will demand multi-institution custody. And it really breaks down for this exact reason that once somebody, an institution, an individual gets material amounts of Bitcoin, something that is greater than, speculative exposure, they will naturally demand better assurances for the underlying, whether it's just custody or custody for the underlying loan that they've taken against their Bitcoin. And there's a number of reasons for that, from the fact that you can't lose the asset, you cannot move it or lose it in a scenario like that. But also when it comes to if one of the custodians is tied up in some kind of bankruptcy proceedings or anything that, would prohibit them from signing or moving the assets are still okay to be moved, depending on the construct. In our current iteration, that's the case because the client remains the title owner of the Bitcoin, and then they're able to direct the agent on behalf of them that is safeguarding that cryptographic material. And so, yeah, I think it's just going to take time, but it's really sad to see. And I can almost promise we'll see more of this in the next 24 months as liquidity comes into the space. The need and the recognition for multi-institution will only become more apparent. That's the thing that I think everyone just fundamentally misses, and would love to take bets on this, is that the liquidity doesn't come in a vacuum. So going from 120 to 170 to 250 isn't all, butterflies and rainbows or whatever. It's actual risk will be inserted because it is still the Wild West, and people love to do weird stuff because they only do weird stuff in the traditional system. This is exponentially increased once you get into crypto and digital assets. And as that happens, that's when the market wakes up to redundant, fault tolerant solutions. We just forgot what happened in 22. And we live in a world that's just traditionally trusting, and it just doesn't work that way in digital assets and Bitcoin.
Well said. I think, that's why many of the people severed the internet connection and took their assets offline in the very early days, because they'd seen so many instances like this, and there are those challenges with, taking all of your Bitcoin offline as well and keeping it on your person. But, the emergence of bankruptcy remote accounts and the ability to actually, use a custodian does have benefits as well. So as it's just kind of like the JPMorgan deal and offering collateral on the underlying assets themselves. Enough customers that become educated will ultimately demand it, and it will just be market forces that push assets from omnibus accounts where you can actually be have your assets clawed back in if there's ever a bankruptcy to more bankruptcy remote type accounts in the future.
Can we go? Or go ahead.
Yeah, go ahead.
Honestly, if we're good with this, I want to go bullish because there's a lot of happenings. I thought we were going to go from JPMC to Zelle because
that's where I was going next. I'll pull that up right now. So Zelle. Go ahead. I was just going to say we were looking up before we hit record because I had some understanding of like what Zelle is. I've used it before, but it turns out it's owned by a consortium of pretty much all the big banks. So that's just a noteworthy disclaimer as we introduce this story and why it's relevant. But go ahead.
Yeah, I mean that was I have an uncle that worked for Wells Fargo, and I don't remember why I ended up digging into this, but there was always a weird. I think because he was initially the person that asked for Zelle, and I was like, well, that's interesting. You download it, but Zelle's fascinating because when you look at the genesis, it was part of the combating of the fintech apps like the PayPals, the Venmos, the Cash apps of historically these systems are, I think Latin America, Europe has really great when it comes to the interoperability of the banking system, where the US is very fractured. And so you'll ultimately end up with these layers on top, right? These databases like a Cash App, Venmo, PayPal that are able to net settle out transactions. And via flows and other reasons, Zelle was established, I think maybe close to 10 years ago. But to Brian's point, it was some of the largest banking institutions, the Wells Fargos, I think US Bank, JPMC. And what makes this really interesting, there's another like 4 others, is that now they're positioning stablecoins for cross-border to start, which is pretty big, because if you have the largest banks getting in that, it doesn't say much about like what blockchain. My instincts tell me that it's probably tied to about a couple of weeks ago, and I think we had called this a few months ago, that the large consortiums like this were going to establish some kind of stablecoin because it just made too much sense from the distribution mechanics. And so anyway, I think this is just a big deal from a directional point of, once US citizens get comfortable with the notion of money being digital and they can move it around, and it just ties that connectivity around being able to, swap into BTC, that this just is a signal for the industry that it's moving in a direction that you're not going to come back from. Now, it's also going to be very Orwellian, because a lot of stuff is going to be, we don't have to go, let's keep it bullish, but it's not going to end up good if people think stable coins are the innovation. The sad part is I think most people are actually going to end up as stable coins are the innovation. I don't think everyone adopts Bitcoin. Started to realize that. That's a different conversation.
Well, there are two links that we have that are related to this too. I don't know if you saw the Western Union news, but it sounds like they're pretty much going all in on Bitcoin. I mean, Western Union, or stablecoin, sorry, not Bitcoin. They've alluded to having a stablecoin partner, which they haven't actually named their names, but they're just pretty much seems to be focusing on expanding globally fiat on-off ramps to stablecoins. It's just going to be, we've talked about this for a while now, but it seems like the move is just, they're going to just essentially stable coinize the world with US dollars as the intermediary, and just making sure that there are different banking partners for all across the world for on and off ramps between these stable coins will be a massive part of that too. It's just going to be increasingly, the currency will probably be US dollar, Bitcoin, and gold as that ramps up a little bit more. And there's just more information, like money is just essentially data and information at the end of the day, except for maybe gold, which is physical. But as that ramps up, just information wants to be free. And so we're going to see greater currency competition over the next decade or so, or even longer.
Yeah, the Western Union deal is particularly interesting to me, just because in a prior life, in my private banking days, we used to cover a manager that had an allocation to Western Union. It was a sort of a long only equity mid cap fund, and this was like 10 years ago now. And in sort of our quarterly updates, I would always bring up the fact that remittances are, in the process of being disrupted in a real way. At the time, I was sort of agnostic to which blockchain would be the real disruptor. But I knew that, from a technological standpoint, that, these guys were being disrupted. So, it's interesting to see, basically a decade later, they're now actually doing something about it. I guess that's sort of to be expected from an incumbent like Western Union, to not see the writing on the wall. That's really been there for several years at this point. But yeah, that makes sense that they're, at least finally moving in that direction of realizing that they're going to have to do something in stablecoin land if they're going to want to be competitive with all these fintechs, all the banks that are going to basically eat their lunch if they don't do anything about it. All right. We had a slew of sort of more crypto deals. If we want to run through some of those, some M&A, some acquisitions. I'm going to start just with this one. Salesforce-backed paytech firm Modern Treasury acquires Beam stablecoin startup for $40 million. I'm going to be honest, I've never heard of either of these companies. Michael, I think you brought this on the list. Any thoughts on this one?
Yeah, Beam I hadn't heard of, but Modern Treasury I have. They're a large kind of, they sit like as a middleware between traditional fintechs or like crypto companies, and then the back end banking layer. So if you think about it, you have an exchange, you have some type of brokerage business, and you need to manage not only your treasury, your capital movement, your cash flow from incoming, but then as individuals are setting up like FBO or accounts with your business, they need API infrastructure to build those accounts, and it all just needs to like talk to each other. So Modern Treasury is a pretty big firm, probably multi-billion dollar. I think, what does it say? Raise 183 million, yeah, $2 billion valuation, and then they just this deal with Beam, which is effectively what is that? Yeah, and so they're part of the Global Dollar Consortium, which is with Anchorage. The main idea here is that you're going to start seeing more and more of like what we saw with Stripe, Tempo, and this integration between startups, fintechs, and the ability to either leverage existing stablecoins or launch your own to manage capital movement. I think the Western Union stuff is obviously big from cross-border, and like that's just self-preservation. I think the Zelle thing is a little fundamentally different because of the plumbing activity between all of these banks. Like those banks probably make up over 50+% of business accounts. You think about, Stripe's involvement with businesses, and then you take something like JPMC, Wells Fargo, and the others. And if those individuals have business accounts and business capital, we talked about before, Stripe only has 1% of international B2B. What does it look like for the Modern Treasuries and these other companies? Because that's really where the real use case is when you think about from scale and actually operationalizing, like to get every user to learn how to use stables to go and send money, and how much money can they send, how much fees can you really take if it's a race to zero, versus if you're a business that is a multinational and you need to net settle from whether it's invoices to payroll, like that's the real disruption. And I think we're going to start to see more and more of that. And that's really where like Acropolis, a treasury or a portfolio company can shine, because the notion of putting Bitcoin as that core underlying asset next to stable coins, I think is something that's not historically been done very well. And there's a big opportunity for that.
Yep. Well said. The opportunity's there to put them close to each other. I think we're a ways away from some of these folks realizing that. I think they're sort of predominantly focused on stablecoins for now. I think they're, for the most part, missing that second sort of leg of what you're describing, where you need to get close to the Bitcoin as savings and have, stables for spending and running a business operationally. So we're probably still a ways away from people realizing the sort of full picture there. I'll go to this one next. Prime broker FalconX to buy 21 shares amid crypto M&A spree. There was another headline that said crypto M&A surges 30-fold as niche firms shift to mainstream. Thoughts on this one?
I thought that this one was super interesting just because I saw an interview with Raghu, who's the CEO of FalconX. He said 20 to 30% of net new entrants into the Bitcoin industry are coming in through ETFs now, which kind of validated a lot of what we're seeing in the space. But also, just like we talked about with JPMorgan, people are going to want some exposure to ETFs, some exposure to spot Bitcoin. And we've seen a lot about how the options on the BlackRock ETFs are actually like outpacing options on underlying Bitcoin itself. And so I think it's just going to be, FalconX is doing a lot that's kind of interesting too, but just the entire stack of, ETFs, options on them. And then just the fact that, these ETFs are just great business models too, because it's a taxable event if you want to actually get out. And so they're going to be able to pretty much charge whatever fee that they want to for a sustained amount of time. They have their own custody that they can move it over to if they want that. And so this is probably just extremely profitable business model for them.
Yeah, I didn't even think about, it's a really great point around, and I don't know how much this took part of it, but like the notion that over a long enough time horizon, when somebody buys into digital assets, specifically Bitcoin, the realization is you want the underlying. There's just going to be a lot more you can do with it. And specifically from a counterparty risk perspective, right? Like the base. If the base is you can insert governance in a world where you never could, then everything else will be a derivative of that. And the opposite is also to be true, is if the base is fractured, meaning you have a single counterparty with the underlying custody, and you create all these derivatives on top, when it unwinds, it's going to be very bloody. With all that said, when somebody first comes in, they're used to buying it in an equity-like wrapper, and then you naturally have that conversion over. But then to your point, there's a lot of other things around execution, financial products, derivatives. One thing that I don't know if you had something on that, Brian, but I do want to pull this up because you tied into it. If we want to keep things bullish, is this was the Bloomberg article that crypto M&A transactions and the amount in Q3 was close to $10 billion, which is basically, I think, about a 3x from Q1. I think it's also just getting started. Like, I've always find it interesting when you see some of these raises. I think we saw some of the IPOs, and it makes sense, right? Like when 10T's a fund that they've really executed well on the thesis that, institutional investors, Dan Tapiro's fund, they couldn't get exposure to Bitcoin. Wasn't their mandate. So the way they would go is invest in growth companies that already had some kind of or definitely had product market fit, and they were like pre-IPO. So the Geminis, the Ledgers, the Deribits, they've crushed it. But point being is they used this past 2-quarter window because it looked like the cycle, the top, right? So you want to go in, and you saw a lot of raises, and you've heard BitGo IPOing. And I think you can't morning quarterback it because we don't know where the market's going to go. But my instincts tell me they probably they overshot, or they shot the gun too early, basically, that we probably 12 to 18 months before that optimal time where there's going to be insane fervor, froth in the market. And this is an example of it. It's if this is 10 billion in Q3, where we're heading in 26, because everyone's trying to place their chips on the table with the acquisition so they can get their integration with what are their plans, right? You've heard Wells Fargo coming into the space, Citibank's coming into the space. Facebook is looking at it. It's always been rumored that Facebook will go back and buy David Marcus to get, Spark involved. That it's really the underpinning thesis of everything we're kind of doing here is there's real opportunities to build generational businesses that are standalone businesses that, effectively print BTC to pass back, but then there's going to be lots of opportunities for companies all over the world and financial institutions to buy these firms. Because remember, similar with the audio investment in Latin America, that's a whole region that's going to need financial services. They're not going to buy a US-based firm generally to go and offer services in the same way in the Middle East and Asia Pacific. So I think this is very bullish for the thesis of these companies are going to there's going to be an insane amount of M&A, and it's just getting started. Next year, we'll probably see 5 to 10x of what we saw in the last half of this year.
Yeah, I think that's spot on. I think this is obviously a huge jump from what you saw on the screen there in the past years, but that's to be expected. We heard 2-3 years ago, there was lots of similar announcements, similar plans in place. And then when everything deleveraged, everyone sort of shelved a lot of those plans. And so it's natural that you saw that dip in activity over the past 2 years. And I think you're exactly right, that we're just scratching the surface of what this could look like sort of in the coming months and years even, because what we do know is that these incumbents, whether the TradFi firms or the fintechs, they're more bureaucratic, just generally speaking. They're going to be slower moving. They're putting their plans in place now. They're getting their chips on the table, but it's going to take some time for these things to actually, be in market, be productized, and we'll just have to see how that plays out. But there was few other deals to run through. Coinbase bought a investment platform called Echo for $375 million. This one was particularly interesting or funny, just given. So Echo is a investment platform. My understanding is it's sort of like a crowdfunding token launch platform, but sort of more credible. Not anyone can just launch a token within the platform. It sort of has to be vetted. And so there's some air of credibility around it. Kobe, who is a crypto Twitter personality, actually started the platform Echo. And he also had a podcast a few years ago called Up Only. Coinbase bought the podcast for $25 million prior to announcing this deal. So sort of a little marketing gimmick stunt to buzz interest around what they would announce literally the next day, buying Kobe's platform for $375 million. Thoughts on this, guys?
Yeah. Thoughts are generally that Bitcoin dominance is not going higher in the immediate term. I think that, this is a good example of the adults in the room, or the perceived adults in the room when looking from the outside. And they're allowing for any company to go out there and raise their own token. And so it's just a lot of distraction too. And so you're going to see a lot of just M&A focused on distraction rather than just the underlying Bitcoin itself. I don't think that there's going to be, I mean, they're probably going to make a lot of money off of this just because they can put their name on it, and there will be other tokens that they will want to sell. And the market's uneducated on what actually creates value over time. And so they'll buy what the perceived adult in the room is willing to put their name next to. But it's just a sign that, you know, the market isn't necessarily as quite as developed as we would all like to see.
Yeah, this reminds me a little bit of like there's a truth in every lie, in the sense that what they'll probably come back to, the pushback I'm about to give on this, is small companies and whatever need to raise capital, you know, and get exposure to additional funding mechanisms. But the reality is this is a big point. It's probably the biggest point around the market structure bill. Haven't followed it as closely, but our friends at BPI have really good reports and just up commentary on what's going on. It really comes down to securities being deemed commodities by the CFTC, and figuring out how do they basically like whitewash all of this and allow things to trade in a more free and not be registered as or not be recognized as unregistered securities. Coinbase is obviously very close with them. The ability to launch anybody their own token is kind of a corollary or similar to like whatever the pump.fund, where you can do it like in a less scrupulous way, you know, on the blockchain anonymously, whatever. But it also reminds me very similarly of a poly market, and everything's going to become a market and we're just all going to trade around on ideas. It's just this kind of high velocity trash economy where everyone's speculating. And we have the piece that we were looking at that we're going to release about, you know, investing on a Bitcoin standard. And it just like kind of is fresh on my mind when you think about, well, when you have a sound money world, you just hold the underlying, you don't have to put it at risk anymore. And that's the opposite of what these people push. It's more of like, here, jump on the platform and then go ahead and get off to the race on speculating. And everyone just ends up with like less money and then definitely less Bitcoin.
Yeah, agree with all that. The other takeaway as it relates to this acquisition in particular is it signals to me that they see, you know, Coinbase sees some real competitive threat vector from like the pump fund platforms of the world, where they're basically missing out on the very earliest stages of some of these tokens or projects. And so I think this is really an effort to own that full chain from like ideation, token creation, launch, funding, all the way to trade, which is what they already own in terms of, you know, when these assets get added to the exchange and then tradable. But it's sort of a signal to me that they see some real competitive threat from the pump funds of the world, just wanting to own that whole life cycle of speculation, basically, from sort of A to Z.
And then it's just like the wrong fundamentally strategy, in my opinion. I think they're trying to compete with the casinos when there are a number of just institutions who just want to safely hold their Bitcoin and you know, and even trade around a lot of their Bitcoin in a serious way and want serious counterparties. And you know, trying to go too far out on the risk curve is going to push away some of those types of folks. Now they have a great brand name and people generally trust them, and so it's only going to happen on the margins. But I think it's a pretty big missed opportunity.
Moving along, this was a late add to the list. IBM launches digital assets platform as crypto activity jumps. I'll pull up the actual press release from IBM here. IBM announces new platform for financial institutions and regulated enterprises entering the digital asset economy. A lot of word salad here, but what do we make of this? IBM getting in the game.
I wasn't able to look deep here, but I mean, if I could think of a top 5 list of legacy companies to not touch, you know, Bitcoin, it would be IBM would be up there. A lot of buzzwords, a lot of HSMs, hardware security modules, blockchain. You know, the level of attack surface, I don't know. I mean, yeah, it's really interesting because I think about IBM and other firms getting into the space and like, relatively speaking, somebody can manage a private key. We see no shortage of different firms launch things. The problem is every day you hear about different hacks, different vulnerabilities. And the thing I always draft to when we talk with institutions is on a long enough time horizon, as the price runs, liquidity comes, people lose assets. And then ultimately people start to wake up, well, what's the difference between your custody versus the other? And it all starts to look the same because either A, somebody's not technical enough, or B, from an operational security perspective, all the way from Coinbase to Fidelity and everyone in between, you can't actually ever tell anybody what you do with the underlying because that's, a source of risk and attack vector. And so you never have real transparency, understanding where the asset, and then also, whether it's bad actors from a collusion perspective coming in and infiltrating an organization to a long enough standing where any kind of counterparty risk, insolvency come to play. You just start to see everyone will step in with HSMs and multi-party computation, all these different ways to custody, but they will lead to vulnerabilities, which will have the market feeling, we'll look for standardized processes. So that's what I really come to think about. IBM's first foray into this is probably going to be a little interesting. They probably won't get much traction to have any vulnerabilities, but interesting nonetheless.
Yeah, we'll see if they come out with anything or if it's just Long Island blockchain iced tea or something like that. And just marketing pitch.
Hey, everybody. Hope you're enjoying the episode. Lots of interesting dialogue going on this week around stablecoins, AI, and a lot of the M&A activity that's happening in the industry. Quick word from Onramp and specifically around our inheritance product. We have no shortage of net new clients and existing clients that came over to Onramp specifically because of inheritance. We've all been in this current situation where generally, Bitcoin is male dominated. Our significant others are perfectly fine with us allocating or even over allocating, depending on who you are, to the asset, but they also don't want any exposure, have to deal with management of private keys, what to do if something happens to the individual, hardware devices, seed phrases, all the things that account for self-custody. And so while clients sometimes feel perfectly fine with self-custody for themselves, it really comes to legacy planning, whether it's with inheritance, the Dynasty Trust release that we had. Inheritance comes with every product and every multi-institution account, included with also insurance, IRAs, and trade. But inheritance is the thing that I want to call out simply because as the price appreciates, as we get older, we start to recognize that we have to legacy plan. We have to be more mature with this asset. And so Onramp really provides peace of mind there. Even if you're not necessarily ready for something like Onramp, but you want to learn more how we solve for that and some of the other, financial products we offer as Bitcoin naturally matures and needs serious products and solutions, I'd encourage you to book time, or you can reach out to me directly, Michael at onrampbitcoin.com. We're actually piloting out some flat reduced base pricing that we're testing out this quarter, and we'll go into 2026 with. If you'd like to opt into something like that, reach out and we'll share more. All right. Hope you enjoy the rest of the episode.
Yeah.
Should we chat
digital asset haven?
Should we chat Tether? Because I feel like there's a number of things, and you guys share where you want to go. I don't really have a direct one. It's like there was Tether and a lot of the notion that came out this past week. They've been talking about this, but like Tether and AI and just how the models will be created and the things they're doing there. I think the investment they're bringing on to really push USAT. And then I don't know if I couldn't understand or not if there's a Rumble token that's being launched for creating and tipping. Because in some of the articles, it said RUM as a Rumble token. And then the other one was that they invested in a firm, which is, I think, kind of interesting, called Pave Bank for kind of like digital banking that I thought was interesting as well.
Yeah, a few different angles to take it. I think the Rumble token, it says right here, distribute the upcoming Rumble token, RUM. It's interesting because when I first saw this headline, I assumed that they were basically trying to turn on, similar to on Nostr with Zaps, like Lightning-based tipping, but it seems like there's going to be some meaningless token involved, which is unfortunate. And then, I'll pull up the other deal, which, I mean, if, we talk a lot about Tether on the show and generally how they think about capital deployment, their reserves, the advantages they have and how they've accumulated those reserves over time, but they also have an investment arm. And so it's probably noteworthy to look at anything that they're backing. So I had never heard of this Pave or Pave Bank before, but raised $39 million in Series A funding, led by Excel, with participation from Tether Investments, Wintermute, and others. Businesses using the bank, which has a license in Georgia, can manage both fiat and digital assets in real time, automate treasury operations, and reduce reliance on intermediaries. So I'm not really sure exactly, why Tether would be interested in this business in particular. It seems like they're doing a lot of these things themselves, but I'm curious your guys' thoughts on any of these Tether-related headlines.
The Pave one is interesting because if you go, I'll pull up their site. It kind of makes sense. It reminds me of the other one we talked about, which was Dakota.xyz. We're going to start to see more of these mix between what we talked about. Like, so Modern Treasury is like this intermediary platform between the front layer, fintech, and then the back end banking or multiple banks you manage. And these digital first banks look like banks that offer IBANs and other ways to take in different types of deposits, so multi-currency. But then they basically sit between the firm. So it's basically vertically or collapsing what would be Modern Treasury as that intermediary management system and then the underlying bank. But then they're digital focused. So then what that really means is robust and more sophisticated APIs, because that's one of the big things with the reason why these fintechs sit in between is because traditional banking APIs are really kind of either they don't exist or they're super they are super unsophisticated is not the right word, but I'll use it because ultimately banks are risk averse and they naturally need to maintain certain levels of security so they don't open up a lot of infrastructure for usage. And so this is where this limitless banking, Pave or Pave Bank. And so they reference multi-asset, 24/7 global banking, and the programmability. When you're a digital asset firm, if you're going to be doing either multi-currency, stable coins, or if you think about a lot of like AI companies, if this kind of ties into what I think is probably the full circle of the stable coin aspect is stablecoins will power AI. It makes more sense than credit card from an inference and a programmability perspective. You go back full circle, and if it ends up being some kind of utility where people need AI tokens for a bunch of things that you'll naturally need in your day-to-day life, it kind of rounds out how USAT and Tether are looking to be with the bank. So they invest in the bank, they issue the stablecoin USAT as the distribution channel. And then you're able to basically build that into the programmability to however stablecoins are going to proliferate, whether it's fintechs, AI companies, or whatever. So I can see it. I think it's going to be interesting to see how long it takes, because I don't know how many use cases are yet available for stablecoins that the market understands and will tolerate. But I think it's naturally coming. It's just when.
Yeah, and starting with the digital asset companies makes a lot of sense. I'm actually surprised that they haven't gone out and bought a bigger bank at this point. I think that Tether is one of those types of folks that wants to, you get a lot of information if there's information sharing rights on just, the types of customers, who's growing really quickly, et cetera, by working with the Pave Bank. And so that's just like interesting to know what, either potential competitors or, other folks in the space are really doing that are interesting that can apply back to your business and just generally how you view the market. But also in a world where I think that they know that the USD isn't going to be around forever just because of everything that's going along with the debasement of the currency, and they're naturally Bitcoiners and gold bugs as well. And so I'm more surprised that they haven't gone out and tried to either create a bank of themselves so they can actually lend directly to those types of folks and actually have eyes on the underlying asset with their own custody type models for, both Bitcoin and gold, which I would be surprised if we don't see within the next few years.
Yeah, one interesting example from what I was reading there, and it'll make a lot of sense to your point too, on the automation of Bitcoin-backed loans on like a micro example. I never thought of this, but like when you think about an Unchain, a Let-In, an Arch, you generally have some kind of minimum because there's operational requirements and you're ultimately originating. And even though like Arch is world-class at originating, making it pretty straightforward where you can get the liquidity, I think Strike's even doing this in some respect. there's still like operational overhead and requirements and collateral management that end up like around the individual level. And you can imagine where in a certain level, the wallet has a deposit, you have your stable coins issued, and then there's automation tied into, everything around. Again, this isn't necessarily you can build a business around this and it's done. But if a banking layer like this could do is out of the box, you could lend against the underlying, leverage their licenses, have a lot of their triggers and permissions around when the price is reducing to top up via, the stable coin, it brings it back up to the margin requirement. Like, I think there's a lot there where you can do it at like $1,000 level or $5,000 level, something that would be less, not economical in today's world if you have to manually do it. I think some examples like that, you'll start to see banks, and that's exactly where the opposite of the traditional banking system isn't. They're used to underwriting and building out their traditional loan origination processes, which are tied into the dollar system around ACHs or wires.
Yep. All great points. All right. Where do you guys want to go from here? We had there was a couple other headlines.
Could we go to the
raise funding? Where do you want to go?
Let's go to the X402 deal with Coinbase and Gemini and Claude. I think that's gotten a lot of traction as of recently. And Michael brought up a good point. I think there's I saw somewhere that they did over 100,000 transactions in a day of just agentic to agentic payment of I think it's mostly stable coins at this point, but it's interoperable between whichever payment or token people want to use in order to pay AI based on API usage. It sounds like some folks internal within Coinbase too are actually thinking about, so how it's going to work is Coinbase will, or you can pay based on your tokens usage APIs in real time, but you could they're also planning to develop a credit card in which you can just pay on credit, but the end user will receive the tokens instantaneously rather than having net 30 settlement. And Coinbase will be able to take the spread on that and actually receive fees for it. So they give you both the option to pay net settle in real time as well as offer credit card fees. And this is going to be extremely important as just the usage of AI ramps up over time, just because in order to find the right information on the internet, there is going to be a lot more people are going to need to be incentivized in order to, run the right models and have everything there for you, because the internet's going away from a advertising based system as more agents just go and try to find the right information for you. And so you'll naturally use it a little bit less. So I don't necessarily know how all of this is going to play out. I know that on a much longer time horizon, those who are pretty sophisticated will want to, save and demand to be paid in Bitcoin. But I think it's really interesting to see, just because we're seeing stablecoins pick up a lot more just from other use cases outside of just being the other side and digital asset transactions and for trading day to day.
Yeah, I have some thoughts, but Brian, curious if you have anything before.
No, go for it.
So this isn't worth much because the bookends are easy in life, in the sense of like, we're here today and then Bitcoin is money in the future. It's how you get there. But with that said, I think the bookends ends up to what Liam was saying is, how do we end up? Where do we end up is in permission systems versus permissionless systems. And I think ultimately where all these large models end up is centralized, controlled, and having whatever ideological bent that's allowed, and will say what is used to being said, and you will use regulated stable coins to access it. And then you end up in this other side, which is permissionless, and you'll have these different models that are going to be governed in certain regions and certain local fashions, and then you'll naturally need Bitcoin. I think that historically, crypto has always been this like test net for where the market will go, because there's more sophisticated people building on it. There's just more dollar attention towards it. And so you see more a surface of designing, but ultimately it's all built on the old permission world that will not like persist. And so then you'll end up on the other side. The thing that kind of gets a little Orwellian is, if we've talked about this a little bit before, around the amount of infrastructure and capital invested into AI that will never be recouped, at least in real terms. And you can just see, if you squint, like how AI will somehow be so pervasive in our day-to-day usage, whether it's, health, checking your own personal health score, access online to do different things where like it surpasses search, that it starts to become a public utility effectively, because you have to pay for the energy, the production, the inferences and everything to run. And so eventually, where the UBI and the stable coins getting pushed from whatever version is like a public good, and that's what runs, but then you're stuck in that system, because ultimately, if that's what you recognize as digital money, as these stable dollars, and that's how you get them, and that's how you get paid from your employer, and that's what you recognize as the US dollar supporting the government, whatever it is, that's one version of people using it. And then you end up in this other version, which is people recognizing that not only what they're getting fed is the right or better version via the algo, but also you have this form of money that's appreciating and probably has better permissioning or better tooling because of the programmability and the interoperability versus these stable coins that will inherently have certain limitations. I think this is where we end on a long enough time horizon. I don't know how fast we get there, but it's probably not going to be good.
Hey guys, hope you're enjoying the podcast. Wanted to give a quick word from early riders. We've had no shortage of exciting announcements the past few weeks. Last week, we announced an investment in Audio, a Latin American-based Onramp based in Mexico City and El Salvador. Wonderful founders, multiple exits, had formerly exited verifiable Bitcoin and launched Swapido, which rebranded to Audio last week. And then also Argo, a Sprott family company. Incredibly excited about the intersection of gold and Bitcoin, and what does that look like for managing and protecting wealth over the next coming, call it decade and beyond. We've included no shortage of research, investment memos around those company fundraising processes, just so folks understand how we think about companies, what we're looking at. If you're looking to build and are trying to get early riders involved, we'd encourage you to reach out. We'd love to speak with you, as well as if you're looking to get involved with early riders, we'd love to talk with you. We have no shortage of other opportunities we're actively looking at. A very exciting 2026 is upon us. And as we talked about during this episode, there's no shortage of M&A. A lot of these companies, the reality is they can't really build. They're going to have to eventually buy companies to really insert best practices, best teams, best infrastructure. So we're incredibly excited what we're building. We're looking for best-in-class talent and folks to get involved. And so if that's you, please reach out, michael@earlyriders.com, or you can reach out via the contact form. All right, guys, we'll talk to you later this week on the last trade, and I hope you enjoy the rest of the episode.
Yeah, and that reminds me of just the notion of ultimately they become public utilities at some point, more so out of necessity because of the energy uses and the need for token inference. Like there was a sort of flow chart or infographic that was showing basically for every $1 of an end client paying ChatGPT subscription. So for every $1 that they're paying in the subscription, there's about $8 of costs that go into producing whatever that the output of that dollar of spend is. And because along that chain of payments and revenue and costs are that sort of circular image that we've seen, the meme around all these AI companies doing deals with each other, that $8 is really just being paid back and forth to all these different parts of the chain. And so you could see a world in which these things do need to become sort of public utilities, and mainly just because there's actually not a profitable endeavor here for most of these companies outside of what we've already seen. So that's an interesting sort of element of all of this as well.
And what's funny though is like everyone knows public utilities are good, or goods are inherently less sophisticated and better than traditional private enterprises. And so that kind of ties into, if it's a public utility, you're going to get the slop that it's given to everyone versus if you can pay additional in a better form of money. Yeah, this is something I've just been thinking about. The other thing that randomly came up, and you'll appreciate because I know how much you love ETH, is I forgot, it was a random podcast, and they were referencing like this internal infighting, and I'll save you guys from ever having to listen to it because I don't know how I stumbled on it, but it was basically describing like this infighting with the ETH community about some of the lead developers going to Tempo. And
Yep.
what was really fascinating about it is like the lack of fundamentals and foundation of all this crap we're talking about, because nobody has any real basis on why they do what they're doing outside of like money and incentives. So the ETH, it was like rumored that they just like ETH pays all these people really bad, whatever. It's not the ETH Foundation, it's some like derivative of it, but it was looked at as like a prestigious thing for if you're an engineer to go work for. And then they like this one main guy had only made like 600K over like 6 years. And he was like a world-class engineer and effectively went to Tempo that just raised, $500 million and is kind of like the hot thing or one of the hot things right now in crypto. And it was this reality of like, it's always just the next thing, because unless somebody fully understands the fundamentals and what's going to accrue value, they're just like missing the forest of the trees. And then it's like, whether it's the philosophy or ideology of ETH and programmability and world computer, but they don't have any real basis. So then they move with the wind because the next thing that comes is the next thing. And then that person's willing to pay them more. And so the next round will be something else that's not Stripe and Tempo when they realize this permission system doesn't make sense. And I thought that was just fascinating because all these guys, if we were on a panel or somebody was listening that didn't really understand what we're talking about, they'd be like, these guys are closed-minded, or like they don't understand what's happening, or this is the next wave. And it's like, sure, it's going to work for a little bit, but the reality is the best technology will generally win on a time horizon, especially the best tooling and programmability. And all these products are inherently flawed because of the lack of interoperability, and also just the underlying counterparty risk that's associated. The market on a time horizon will realize all of this, but they don't get it. Like and a lot of it just comes to money. It's the same thing with the DATs, right? Because like people went to DATs because they were promised, either large equity payouts by form of shares and also base capital. And the market inherently doesn't, think critically. It just follows what the certain trend is. So if all these people are raising DATs or Tempo and stable coins, well, then it must have some innovation versus really just getting back to the fundamentals. So I just thought that was interesting with ETH, and then this next cycle, people are moving on to other blockchains.
Well, yeah, I think part of the story there as it relates to Ethereum is effectively like, put aside the flaws of these permission systems that we're just talking about. But that is effectively where they see, these developers are seeing the puck going in effectively abandoning what was historically sort of this decentralization theater around Ethereum. Real world assets, stables are going to run on these permissionless, quote unquote, permissionless rails. That's sort of been abandoned in favor of whether it's Tempo or Stripe or any of these fintech incumbents who are just going to build their own blockchain. Tether's going to do the same. And so I think it's natural to see flight from those prior ecosystems, which thought they were being decentralized and building things with a crypto forward ethos. To me, this is just indicative of effectively the abandonment of those theses and those narratives, and just saying, no, like we're just going to build centralized databases. That's what the market actually wants. Like that's where the product market fit is for these stablecoins. It's no one actually cares if they're decentralized or not. They just need to be fast and cheap, and we need to, trust the issuer to some extent. And so I think that's exactly what you're seeing play out. And so yeah, the Ethereum community is butthurt. As always.
I mean, on that note, I know Liam brought that link, and I don't know if you want to pull it up or if there's anything that just stood out on the A16Z article or the report that they put out.
Yeah, I think that there are just a lot of people who just fundamentally view the industry incorrectly. I think one of the biggest metrics that there is just like these people are trying to value Bitcoin and all the cryptos like they're just companies when they're fundamentally different. There was Solana and Hyperliquid are capturing the I think it's, I don't know exactly what slide it is, but Solana and Hyperliquid are capturing the majority of real economic value today, a big shift from Bitcoin and Ethereum's dominance in the past. And how they're measuring this is the amount of fees that each blockchain receives or is willing to pay. And they think that just because that's like pretty much like how you capture value in businesses, is like how much are customers willing to pay. And so they're just fundamentally looking at all of these blockchains, which with the idea of like, what's the network and customer willingness to pay, rather than the actual like how much value is it bringing to customers, not how much are customers paying, right? And so that's a massive fundamental difference, which with I think Bitcoin's brought all of us a lot of value by being able to store more of our money over time, and low fees have been nice because we've been able to move our money around on a relatively cheap basis. And so I think that there's a fundamental difference, and that's kind of how all private equity thinks as well, which is just like, okay, if the business isn't capturing value, it's not worth a lot. And that's fundamentally different with how much value they're actually delivering to their end user or end customer. And so I think it's just an off way of thinking about the industry. And then there were a few other charts in there that were interesting, mostly around just like stablecoin usage, decoupling from actual transaction volumes out there.
Yeah, I mean, one thing I'll say about some of this transaction, on-chain economic activity is this is not good data. And I say that from experience from my time at Coinbase, like assessing some of these other blockchains, like there was always this issue or concern of just looking at the high level transaction data or volume is just not indicative of actual economic activity, because for a lot of these things, the easiest example is probably just meme coin trading, which is predominantly occurs on Solana. The vast majority of that trade volume is just not real. Like it's not actual economic activity. And so there was always this process, even at Coinbase on the sort of investment research side that would say, well, we have to discount this activity to some extent because we know that a lot of it is just patently not real. And so I would take a lot of this stuff with a grain of salt, because what is being sort of heralded as on-chain economic activity is not always such.
Yeah. The thing I think about with all of this is ultimately like there's so much liquidity and so many dollars in the system that you end up with all of this Frankenstein style, like just these metrics and these numbers and these decks, and everyone working on this, the majority of people believe it's real innovation. And there's a lot of incentives to doing it. It's kind of similar to AI, where AI, really popped up. I think GPT launching in 22, maybe 21. And then kind of like the fervor really picked up, and how many like hundreds of billions of dollars have been deployed there. And similar with like crypto, every couple of years you have new cycles. The A16Zs of the world and other large firms, they have real political capital, real lobbying dollars to not only further an industry, which we're seeing with this market structure bill, but then ultimately bring in large scale capital allocators via their previous funds, but also their names and brands and under the guise of innovation. And so you end up directionally with innovation, which is happening with the ability to like move capital and store wealth. But then everything else ends up with all this noise. And so you see like how much money has been deployed into crypto, and right now we're in this like uptrend. So there's these metrics that you can mask and like hide that look like positive growth. But the second the market ends up in those bear markets where ultimately people aren't speculating, then everything and all the volume ends up going back to effectively nothing.
And we saw that, right? We saw exactly that 2 weeks ago in the flash crash, when market makers step back and there's actually no volume for these things, and they can crash 90% in 10 minutes.
Yeah, no volume, no traction. And I think the key point there is, it's not to say there's not money and value to be made, value to capture, value to accrue, but it's around the fundamentals, as Liam was sharing, around like, as you bring in all this capital and awareness, well, people naturally end up going through, sometimes they have to touch the stove and they're like, okay, well, this thing has fundamentals. There's only 21 million, XYZ. Maybe I want to park more of my capital there. Well, then now I need to figure out, how do I figure out the underlying custody? How do I lend against it? how do I have a best-in-class financial service partner? Generally, those are going to be in certain regions. Stablecoins are of value in the sense that we still live in a dollar-denominated world, and the ability to move those from a capital movement perspective. So there's things that will accrue value, but it's really coming at through that lens. And then you still have to add to that, well, what are the right building blocks around how do I return more capital if I'm looking at it in a Bitcoin layered world? Because if I raise, 10 million bucks and I really don't have visibility into how to return anywhere near that, well, the rational thing to do is build slow, hold that money in Bitcoin, and then build value added services. And this is how we think about when we're looking at companies investing in the exposure we get. And so it's very similar to when I think about multi-institution, not really having any competitors, because you're ultimately competing with firms that are doing things in a to the market that understands multi-institution, the value it provides, as inferior offerings, in the same way that when we have investments and our investors, they look at us and we're looking at a fundamental different landscape on the type of entrepreneur that's trying to accrete and deliver and return more Bitcoin, to the type of companies that are seeing through the noise of crypto and understanding, okay, well, there are market opportunities, and then Bitcoin really is going to be the net settlement layer around any innovation around stable coins. So there's a lot of opportunity with all the noise, but you have to be able to understand it and see through it. And generally that comes with time. That's the sad part, is it's very hard for somebody out of Silicon Valley or Wall Street. And you guys know better, and Liam being closest to that old world before joining, of how many people. We were on a call last week with one worked at a large hedge fund, and is used to trading and all the things associated. But when it really comes down to, well, what's the right way to do this, and what's the right way to think from first principles if we're going to insert risk into our own trying to return capital? Well, when the market gets really hot, is that really the time to really take a step back and think about what's happening? Because usually that is preceded by kind of a downtrend and a deleveraging. All these things people just have to go through. And there's a real proof of work of just being in the market, seeing these things that I think most people are lacking. And that's really the opportunity for us.
Exactly. Well said. And it's about durable things that deliver value to their to customers that they'll pay for over a long period of time. Some of these things that are going on in the AI space are not necessarily that, as well as went through a little bit of Galaxy's financials just because they reported Q3, and about half of their assets are assets under stake, and they're seeing a massive jump in customers of DATs who are now staking with them. And it's just it's not very we've seen this with cycles in the past. The DAT phase is, I'm not going to say it's over, but maybe for some of these other coins, it's not necessarily going to be as durable as something offering, even though we know qualified custodianship is not necessarily perfect, offering custody, trading, lending to financial partners on Bitcoin who will be there for a long time and who actually understand where this is all going. So it's just a massive divergence in the opportunity for the space and where some of the other folks are focused on.
Yep. It's it all comes back to distorted price signals to me in some sense, whether it's looking at phony transaction volume data, which then people build investment theses around that poor quality or low quality data, which then leads to funding and all this M&A and all these acquisitions. And so there is sort of this self-referential loop component to all of this, where people are leveraging data that is sort of mischaracterizing the actual economic value being created with a lot of these protocols. But by and large, a lot of these entities that are doing deals and investing in these things don't care, because they know that there's money coming in, and the end result of that, however, is that there is going to be a lot of capital destruction and malinvestment that occurs as a result of this. So just something to keep in mind. All right, gents, we're a little over an hour here. Anything else you guys wanted to raise before we step away?
No, I think we covered a lot. I think it's going to be a pretty exciting, TBD on exciting end of year, because this volatility is a little off with what's going on with China, Trump, and everything else, and market structure. But I think 2026, it feels, maybe famous last words, but 2026 is going to be pretty wild and active from this area of the industry. It seems like things are just getting turned on from the plumbing from institutions all the way to retail investors. And we just need a little bit of uptick and reflexivity with the market sentiment coming back. And it's going to be an interesting next probably 12 to 24 months.
Yeah. And I know you don't like to talk macro on the show, Michael, but big week in general for various events. Interest rate decision Wednesday, Powell comments, lots of big public company earnings, and then Trump to meet with Xi on Thursday. That comes in the wake of the sort of tariff on-off volatility that we've seen over the past couple weeks.
That just means a great Friday night pump after all that.
Yeah, could be. Could mean exactly that. All right, gentlemen. Thanks as always. See you next week.
Wonderful. See ya.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.